Good morning, Sana. Are you online?
Good morning, Jay. Can you hear me now, guys?
Yes, we can.
Oh, perfect. Thank you so much. Thank you so much. Good morning to everyone. Apologies for being late. I have just connection issues, but I'm sorted right now. So we're going to start the session. The session is going to be recorded for anyone who wants to know. We'll also share the recording after the session is done, together with the materials we're going to use today. Let me just check if everything is recorded just now. Start. Oh, sorry, to record. Okay, perfect. Okay, perfect. Let me just project my screen for now. All right. So how the session is gonna go, you know how the drill works now. We're gonna start with that test one preparations. But before we can do that, I just wanted to know if you guys have any questions that you would like us to go through first, or you would like me to go over the test one preparations, then we go over the assignment question. So there's an assignment question that I've prepared for you for the session. I'm also gonna share it after the session together with the solution. So I'm just gonna go to the chat to check if there's anyone who wants to say anything. Who wants to say anything? All right, I'm just gonna go to the chat session, chat session, chat session, chat session. Or just give me a thumbs up if you want us to start with test one preparation tips. Okay, I see a thumbs up. I see a thumbs up. Okay, perfect. Let me just project just now. All right, all right, all right, all right, all right. So the approach for test one, obviously to cover three learning units: learning unit one, learning unit two, learning unit three. Learning unit one being IS 19, that is events after reporting. And then learning unit two being IFRS 15. Learning unit three being IS 19, your employee benefits. So unlike test one and test two from first semester, I don't foresee a lot of integration in terms of these learning units. I foresee each learning unit being asked independently. For instance, you to expect one question for learning unit one, another question for learning unit two, and another question for learning unit three. So at least a minimum of three questions that you're going to be asked. So it should be relatively easy in terms of answering. However, we also need to note the fact that there's a lot of content that we need to cover in particularly for learning unit two, which is revenue, IFRS 15. So we're going to just go through all of these learning units, but not in detail, but just at a higher level. So you're more than welcome to stop me during the session if you have any questions, because I'm not seeing the team side for any hands up. Right. So obviously, I'm hoping your lecturers have given you lecture slides. So I would say start there first, and obviously use a textbook, the prescribed textbook, to learn all of these learning units. And I hope by now you have done so. So I'm not going to waste your time. So let's start straight to learning unit one. So what can you expect in here? So it's very simple. However, it's very much integrated with IS-37. What is IS-37? It's your contingent liabilities, your pure liabilities, your provisions, all of that was learnt in first semester. So you kind of expect those some of the terms when you're answering your questions. I think I had shared some document with you, in fact, with your lecturers, at just the beginning of the semester, just after learning unit one or during that session. So there were various examples. They were including IS 19, IS 10, which is the events after reporting. I do hope you have that with you, because it also will reinforce a lot of topics that are being asked or expected to be asked out of you. I know there was some part about I think an example with where a client was suing that business for poisonous items and all of that stuff. I don't think those maybe will be asked, but maybe a small bit of them. Because I think that question, I took some of it in one of my postgraduate resources. But in terms of answering everything you need to know is exactly how you need to answer. So without wasting any time, the very first thing you will need to know is that it's an adjusting or an unadjusting event. You are going to have to give those ones out. So the questions are going to be exactly asking you, is this an adjusting event or an unadjusting event? So you need to be able to define those two terms. What is an adjusting and what is an unadjusting event? And after defining those terms, and then you must apply that to the scenario. So what do you mean by applying to the scenario? We basically just mean that explain why do you say it's an adjusting event. So if it's an adjusting event, it must have been providing information that already existed before year end. And the most crucial thing you need to know in that exam is to highlight your dates. You need to know your timelines. You need to know what the year end is. Because once you know the year end, then it's easier to pinpoint the period where the events are emanating from and whether there was already information that existed before year end regarding this stuff. So we've seen trade receivables, basically our debtor going bad or experiencing financial difficulties throughout the year. So what we want basically now is to provide for allowances. So most likely all of your trade debtors are likely to be what you call adjusting events. So we need to be able to explain what is an adjusting event and in relation to some of the data questions. And in most times, you don't need to be aware of their financial difficulties. But what they usually say in the question paper is that most of the examples that I've seen so far, they would state that the debtor was experiencing financial difficulties throughout the year. And then as a result, you as the entity process the credit loss allowances, and then it's only after year end where the lawyer would have sent a confirmation to say, truly, we are experiencing financial difficulties and we are going to actually reimburse not 100% of the amount that we owe you, but maybe 50%. So what you need to know there is that they were already experiencing financial difficulties throughout the year. The fact that the lawyer provided the document or a confirmation after year end bears no fruit in terms of us concluding that it is an adjusting event. So it's merely just providing information that already existed as at year end. So your job now is to calculate the relative percentage that we are hoping to get, and then after that, we are going to put a credit allowances for the ones that we're not going to get. So remember, in most instances, they would have already processed the credit loss, probably less than the amount that they should have processed. So your job is to then process the difference. So luckily, in one of the examples, we are going to do that in terms of that receivables. And then other examples that I've seen being asked are dividends. They're like dividends. So you have two types of dividends. Well, for the realms of IS 10, in the sense that you will have the one that is being issued during the current year. Again, your timeline is very important. So the one that is being issued in the current year of assessment, obviously that means it's an adjusting event. Again, you need to be very careful now when you're explaining why is it an adjusting event, especially for dividends that are issued during the current year. So remember, when I'm saying during the current year, I'm meaning before the end of the reporting period or as at the reporting period, but not after. So when they issue that, you need to explain, okay, number one, it's an adjusting event. Okay. Why is it an adjusting event? It's due to a constructive obligating event. What is this constructive obligating event? And why are we speaking about a constructive obligating event under the IS 10 realms? Remember, when you declare something or when the directors declare the dividends in this case, they are declaring basically issuing this communication to the affected people, which is the shareholder. That reminds us of a standard we've already done before, which is IS 37, where it's asking us, is there a present obligation? So due to that constructive obligating event, meaning the word declare. So when they say the word declare, that means there is a constructive obligating event. They don't have to tell you that they actually send a communication to shareholders. That the word declared itself is enough or sufficient to conclude that there is a constructive obligating event. And then once you've gotten that part, you need to explain further and say that this constructive obligating event will thus create a present obligation. And this present obligation is a past event. What is the past event? Is the date of the declaration, which is in the current year of assessment. Hence, we are adjusting and providing a liability or paying for this. Remember, our offense journal entry is always going to be debit, dividends paid, and then crediting bank or crediting dividends payable, whichever is the case. So if we've paid them immediately, that means we're going to credit bank. But if we haven't, that means we're going to put dividends payable in that journal entry. Hence, it's an adjusting. When you say it's an adjusting event, it means there must be a journal entry that must be processed in the records or some sort of an adjustment. It doesn't have to be a journal entry, but some sort of an adjustment must be done in the financial statements. Right. Now that we've covered the first part of the dividend, let's speak about the dividends now. So let's say we are obviously in 2025 year of assessment, the 1st of December is the end of the period. And then now we issue a dividend on 3 January 2026. But this dividend obviously is for 2025. So we're asking ourselves, and during this time period, let's say from 1st of January up until the 30th of January 2026, that's the date before the financial statements have been issued or authorized. So if we then declare dividend on 3 of January, that becomes a non-adjusting event. Again, why is it an adjusting event? Let's go back and revisit IAS 37. IAS 37 says that when you declare something, that's the only time there is a constructive obligating event. So before the 1st December 2025, we didn't have any declaration. We only had it on 3 of January. That means a constructive obligating event only arose on the 3rd of January. So that's the only time we are going to then recognize that dividend. So in this case, it becomes a non-adjusting in the fact that since there is no present obligation in the form of the constructive obligating event, then we can't recognize a liability. Why? It's so simple, because the definition of a liability has not been met. And if the definition of a liability is not met, that means it can never be a pure liability. It can never be a provision. And in this case, it may be a contingent liability, but in this case, it's not, because there is no present obligation or even a possible obligation as at year end. It's only now on the 3 of January 2026 where we have a constructive obligation event. So you mentioned to the marker when you're answering that, okay, sure, there is a present obligating event emanating from a past event only on the 3rd of January 2026. Meaning that it's an unadjusting event. The only thing we need to do is to disclose it, but on which financial statements? The ones on 2026 when it was declared, or the ones in 2025 when it was not declared? So then that means we only disclose this on the 31st of December 2025 on those financial statements when it was not declared, even though it was declared on 3 June. But because it's during that time where the financial statements have not been authorized, that's when we can actually adjust now our financial statements by providing a disclosure. The disclosure will just tell us the value of the dividend, the date of the dividend, and then any other details that you think are important. But make sure you include those two, that the dividend was declared on this date and this is the value of it. So that's the disclosure that we kind of need, or the information that you're going to have to mention when they ask you if it's an adjusting or a non-adjusting. Right. Dividends are fun. So you just need to note those two. So I've explained it here in much detail. So that's for you to read. And then let's talk about going concern now. So what is going concern? Now, going concern is more of overall, because you're looking at a bigger picture right now. You're not looking at just one line item, which is your dividends, or your revenue, or whatever is wrong with the financial statements, or even trade receivables, but you're looking at a bigger picture. Now, I like making practical examples because I feel like they reinforce the topic even more. So I'm just going to be making examples just to explain the going concern principle in terms of the IS 10. So think about it this way. Let's say that I'm a new what do you call it, the KFC guy. So I just discovered the 11 secret recipe, back in the day, So I'm excited. I'm making my chickens, all of that, and it's booming. Everybody loves the chicken. Everybody's buying. Basically, the word of mouth is good. Everybody's talking about it on the streets, and I'm getting orders. Basically, my business is thriving, And then for some reason, I get into an accident. And in this accident, unfortunately, it takes my life. And I am the only one who knows this 11 secret recipe. Do you think the business will continue to exist if there are no record of this 11 secret recipe and I'm the only one who knows it? And I'm the key management personnel, basically the founder of this company. So The founder would be a key management personnel. Your directors would be a key management personnel. Your chartered accountants, your financial directors, all of those people. So that means they have a sort of expertise, just like me. So do you think the business will continue to go on if the person who knows the secret, the 11 secret recipe is now gone? The answer is definitely no. It won't go on. It will continue to exist. That means that even though didn't affect revenue, trade receivables, but due to that knowledge, that information that I have towards this business, then there is no foreseeable future of this business existing. That means there is a going concern issue. So please look out for the words key management personnel, because what I'm trying to say is that some businesses are founded on the basis of research, and this research are done by experts, and there are not so many experts. I'm not only talking about South Africa, I'm talking about globally. Education is one of the things that is not what do you call that is not popular, or academia is not something that's popular amongst the what do you call the generations that we have now, even though so many people are actually embarking on it. But we can also argue that it's not one of the things that are popular. A lot of things now that generate income are your creative stuffs, which for instance, your social media, the Western world is taken by it. They don't even have real jobs. They rely on those, So what I'm trying to say is that there are certain directors, there are certain CEOs who will have PhDs who would have embarked on research, extensive research, technical knowledge that is not known by many people, so that when they actually now pass away, they pose the risk of a going concern, because that knowledge could have been used to continue with the company. So if they tell you that there has been unfortunate news happening to the key management personnel, think about the going concern issue. Think about the KFC 11 secret recipe on how it would go. So how do you then answer a going concern in an exam? It's fine. You just explain. I just say, okay, the key management personnel here, that's an important or an integral part of an entity. And if, for instance, they are gone, that means this is a threat to a going concern. Full stop. Any going concern issues are always adjusting events. I'll repeat that part. Any going concern issues are always adjusting events. Why are they always adjusting events? Because we don't have the extent of how much could this impact the business. It could impact everything from revenue, cost of sales, a PPE, basically impairing everything. Remember IS 36 in the first semester, when there are external factors or even internal factors that happens that require us to actually now impair our assets. Everything could be impaired. Everything could just go downhill. So in that case, you mentioned that there is a going concern issue. The financial statements must be adjusted. Okay, and then how do we adjust this? By following the liquidation process. So the liquidation process is something that is a little bit intricate, so we don't cover it in terms of your module, but you need to mention that in the answer in the exam that due to the fact that there is a going concern issue, the financial statements may never be prepared using IFRS. What do I mean by that? I mean normally by applying your IS 37, by applying your IS 36, by applying your IS 2, your IFRS 15, we can no longer now do that. So the only thing that we need to do is to liquidate. What do we mean sometimes by that? It just means selling assets. So basically, all the assets that we have, we're just going to sell them, basically just wounding up the business, because there's no reason for the business to continue existing. So I'm hoping that covers most of the important parts in terms of your IS 10. Then the rest of the stuff is just a matter of practicing the questions and any other questions that you are finding on the book, and also any of the ones that I've given. So I'm going to come to the screen just to check if we are still fine, if we don't have any questions, before we can move on to learning unit 2, which now speaks about IFRS 15. So let me drop on, check. AFS, annual financial statements. Oh, okay, sorry. I'll try to slow down. I'll also try to repeat as well on parts that I think are complex. All right. I don't think we have any other questions. So I'm going to proceed to go to learning unit number 2. So the learning unit number 2 is it's the IFRS 15, which is now revenue from contracted customers. Now, this is a fine chapter. I love this chapter, one of my favorite chapters in terms of accounting. I'm hearing some noise. I'm not sure if someone's having a question. Let me just check on the screen. Okay, I think there was a mistake. Okay, perfect. All right. Okay. So as I was saying, IFRS 15 is one of my favorite chapters from all of my years, actually. I think it's one of the easiest, easiest chapters I've ever heard. Which one else is easier? Maybe IS-10, but when you go to postgraduate studies, it can be a very much of a nightmare, especially when you're dealing with going concern and your IS-37. I have what do you call, I have trauma with that standard. But with IFRS 15, I've always made sure, like, you can never fail that one. It's so easy. So without wasting any time, there's a five-step revenue model that you need to understand. It's a five-step revenue model you need to understand. You can never go to that exam without knowing the five-step revenue model. So we're going to count the steps because there are five. We're given that one. So we're going to have step number one, which is identify a contract. Okay. How do we do this? So in my slides, I was very much extensive in terms of signifying that there are five criterions that you must list in order for you to have a contract. And then, but I did notice that from the textbook, it doesn't really dwell on that. It just provides, let's say, one or two line that says the contract exists. But let me just speak on these characteristics. Perhaps you can use some two or three words with what I'm saying so that you can conclude to yourself that truly there is a contract. So basically, what step number one emphasizes on is that there must be two or more people or more parties who are agreeing on the contract. Basically, either one is agreeing to sell something, other one is agreeing to receive cash for that. So they must be willing to actually fulfill their obligations. And then obviously the payment terms must be identifiable. So they will tell you that it costs, 20,000 or 15K or 100 Rand, whichever the case is, but it must be identifiable that we can pay this. Either it could be in cash or credit. Doesn't have to be explicitly mentioned in this scenario, but it's something that is implied. For instance, when you go to Woolworths, when you're buying a cake, for instance, you go there. If you have a card, obviously, if they allow credit cards, like if you buy on credit, then you can do that on credit. But we all know that you usually just go and buy on cash, take that item, put it, go to the cashier and then pay for it. So that's the idea. But in this case, but you will also be dealing with different, let's say, industries. So it's not going to be that simple in other industries if you have a contract or not. Because think about your construction businesses, like if you're asking a construction company to build a house for you, you will definitely then need more than just what you call implied services. You will need them to be explicitly mentioned as to what do you want, what specifications, designs, and all of those things. And then also, it must have commercial substance and yes. So if you can center your answer around those concepts when you're answering step number one, which is identifying a contract, then I can guarantee you that you will get your maximum marks in terms of step number one. And I don't foresee a lot of theory within step number one because from past papers that I've been checking out, I haven't seen any theory question. But for postgraduate studies, and I know for become accounting students, third years, it's difficult. They have to answer theory questions out of revenue. And I've also answered a theory question, I think it was 20 marks just based on step number one only. So it's possible for that to happen, to identify if there is actually a contract. And then once you've identified that part, you go to step number two. Step number two now is identifying the performance obligation, right? Performance obligation. Let me just check. Performance obligation. Performance obligation is all about, yes. So it's all about knowing what is a performance obligation. Number one, be able to define that term in the exam and also be able to define what is a distinct good or a service. And after that, be also able to define the three criterion that we also use to assess whether a good is distinct or not. And sometimes also a good can be distinct in the context of the contract. For instance, I made an example in class. This example was about building a bathroom, and I think my students will remember this one. So what happens is that when you're building a bathroom, obviously you don't just snap your fingers and then boom, it appears. You need materials, building materials. That's number one. Two, you will need electrical supplies, for instance, to make sure that you put all your wires in your bathroom properly, your electrical wires. And number three, you will need labor. you know. And then now, logically, let's sit down and discuss this. Can you buy materials individually without buying the electrical supplies and labor? The answer is always yes. You can go to any hardware store and buy building materials. Okay, sure. That means that good is distinct. Why? Because it's capable of being consumed without actually having to buy other items on its own or together with other readily available assets. Okay, now let's continue with the second one. Now we have electrical supplies. Again, same question. Can you buy electrical supplies individually without having to buy building materials and labor? The answer is always yes, meaning that it follows the same suit, meaning that it's distinct. It's a distinct good. Why? Because it's capable of generating revenue without having that item to be used in relation to other. It can be bought on its own. Let's go to the labor. Is it possible for you to buy materials, electrical supply separately, and then ask for labor in a different company? Definitely, it's very much possible. So that also means that labor as well is also a distinct good and a service. But now let's look now at everything in total. The contract didn't say, I want a building material, I want electrical supplies, I want labor. They simply said, I want a bathroom. So that means now all these goods now will no longer be distinct individually, but now will be distinct in the context of the contract, meaning that we'll only have one performance obligation, even though we understand that individually we have three performance obligations, but now we now have one because the contract explicitly mentioned that we need a bathroom. So you will need all of these items as inputs to generate an output, which is this bathroom. I hope that makes sense. So that's the reason why I'm emphasizing on the definition of distinct goods and be able to provide examples as well and all of that. And then that's step number two. Is it capable of theory question? Oh, definitely, but not in your test one. I haven't seen any past test one questions asking for step number two as part of a theory question. But I would advise you to know what is a performance obligation, what is a distinct good and a service, and then what is a good that is distinct but in the context of the contract. Okay, perfect. Then we move on to step number three, our lovely step number three, which is determine the transaction price. Now, that's a lengthy one. Determining the transaction price is a long process, but it basically introduces the concept of constraining. So remember, this is a new standard, IFRS 15. How do we know it's a new standard? Because of the word IFRS. Most of your old standards start with IAS. So your IAS 10, IAS 37, IAS 2, which is the inventories, all those that we dealt in the first semester. Well, some of them are really old standards, like back in the 1980s, 90s, they were established around during those times. And then the new ones were only refined in the 2010s. 2010s, why were they refined? It's because there were inconsistencies with the ones that already had existed. Because there was a revenue standard, which was called I-17, but then it has a lot of inconsistencies in terms of recognizing the revenue. A lot of they noted that a lot of companies would either provide a profit, sorry, a revenue that is understated or a revenue that is overstated. So then it brought a lot of lack of trust in terms of the IFRS board to say, how can you create a standard that seems like for every entity there's always what you call an overstatement or an understatement. So then they created IFRS 15 to refine those misalignments. So now hence they introduced the concept of constraining, meaning that we want to make sure that we don't just say we recognize revenue, but then later on we change, we subtract or we add more revenue than we were supposed to do at the beginning. So we need to constrain these amounts immediately when we enter into a contract, so that we are able to understand, so that we're able to get a faithful representation and some relevance. Now, your step number three, which is now you're determining the transaction price, is affected by a lot of factors. Number one, variable, what you call variable factors, which are your discounts. Hence, now it's very much important to understand what are variable considerations. Remember, variable consideration doesn't have to be a negative or a positive. What do I mean by that? Okay, now let's think of it logically. Now, we're selling goods and services for 100,000 K, okay? And then we offer a discount of 10%. That means definitely our revenue
Kanjani
will.
ngoba nginayo i-app bheka
I hear someone
ngithathaphi i-app
talking. I
i-app
hear some.
idinga i-app ngiyakutshela nje ukuthi idinga i-app efonini bheka
I hear someone talking. I've muted the person. Okay, perfect. Okay, perfect. Now I lost my thought of. Okay, perfect. I was in variable considerations. So I was saying that it doesn't have to be a positive or a negative variable consideration. So I'm going to explain more. What do I mean by that? So a negative variable consideration would be if we are selling goods over 100K, 100,000K, and we receive a discount of 10,000. So obviously the amount we are hoping to be entitled to, underline entitled. So it's 90,000 because we just gave them a discount of 10,000 or 10% in this case. So that's a negative variable consideration. We can also have a positive variable consideration. What do I mean by that? Instead of now getting the 100K, we can get more than that. Now, think of other industries, how they operate. Sometimes other industries, they add on additional amounts. For instance, even the construction industry. For instance, I can enter into a contract with a construction company to build, for instance, a house for me. And then I say in this contract, if I really, really like this house, if you've built it according to my exact expectations, I may give you 20% extra in terms of the price. You see, so that's also a variable consideration because now it depends on a future event that is not yet happened. It depends on something, on the completeness of the thingy, of the project, and if I like it as the customer, that means I can give the 20%. You see, that's also a positive variable consideration because you can expect to know more. So I think I also did provide this on my lecture slides. They should help you there. And then we could also have more negative variable consideration, such as your settlement discounts. What do we mean by that? It means that they could give you, you could buy, a customer could come to us as the entity. Let's say they are buying goods of 5,000 from us, and then we give them on credit. So they're promising to us that they will pay this in 30 days time. Okay, perfect. Now walk with me. Now we give them a settlement discount immediately. We say that if you pay this within 30 days, then we will give you an extra 5% discount. So revenue says that is a variable consideration. And we can never recognize revenue at 100% because there is a variable consideration we need to take into account, even though it hasn't happened yet, but we need to ensure that we account for that one. So it makes sense then our revenue that will actually take into account the 5%, and then we will minus the settlement discount, the 5%. And now when the event happens and then it arrives, then now we look at the facts and circumstances and adjust accordingly. So I've also provided examples of those ones, hence the term constraining effects. And then what else do we have under step number 3? We have significant financing components. That means that if a customer has given us money before we can issue the service, that would mean that it's a revenue received in advance. So we will need to account for time value of money. And then also it's possible that we could deliver a service immediately to the customer, then they pay us in 2 years' time. That's called in arrears. That means we also need to account for the time value of money. So make sure you understand those before you can go to the exam. Also sales with returned, so sales with returns. I've also provided more on that slide, on the lecture slides. I'm hoping the textbook also has that. I think it does, yeah. And then what else? What else is there? What else is there? Okay, I think I've covered most of the important stuffs under step number 3. Okay, perfect. A theory question, can it be asked on step number 3? If they woke up on a bad mood, maybe they would, but I doubt. I haven't seen it being asked in the past test. But I think they would be nice this time. And then let's move on to step number 4, which is allocating that step number 3 now to step number 2. So what are we doing? We're simply allocating the transaction price to performance obligation. Okay. So it's very simple in here with the allocation. All you just do, you just need to count your performance obligations and using the standalone prices for all of this, and then making sure that after you've used the standalone prices, you allocate accordingly. So you likely find that you have a discount. It's very simple. I won't even spend too much time on this one. Step number 4. It's the friendliest step I've ever seen. And then go to step number 5. Now that's a beast, step number 5. And I think that theory may be asked now in this case, step number 5. But obviously, we don't want to to overthink too much. But step number 5 is basically now recognizing revenue when we have performed the performance obligation or fulfilled the performance obligation, meaning that we have no business under any circumstances recognizing revenue if we have not performed the obligation. So you need to think of yourself as the entity. Ask yourself, in which date did we actually perform the service to the client? On that date, that's the only date you can recognize revenue. Any other date before that, you have no business recognizing what you call revenue. Think of it this way. So let's say that I'm selling shoes and all of that stuff, right? I'm selling shoes, sneakers and all of that. So a customer comes and buys in bulk, let's say 5,000 sneakers from me. And then they just give me the amount immediately, because let's say it's a long-standing customer, they trust me, So they can send me this 5,000. They say, please deliver this in next week, So in this week that you've received this amount, surely something is going to happen. A journal entry needs to be processed. It's very simple. The first one, debit bank, because we have received 5,000 from this customer on that first week that we have received on that day. And then what are we crediting? We're crediting a contract liability. Why? It's because we have a contract here. I hope you can agree with me. There are two people who are willing to perform the services. I'm willing to give the sneakers because I have them, but obviously the customer is also willing to give me the money, but just delivery happens in 2 weeks' time or in 1 week time. So you see, we do have a contract basically, and we also have a transaction price, which is the 5K. So that means we almost have everything in terms of revenue, the revenue 5 model thing approach. But now what we don't have is that step number 5. I haven't yet delivered the sneakers. So that means I have no business recognizing revenue. That means the credit net there would never be revenue, but contract liability. Why? Because now I have a duty, two duties actually. I have a duty to either refund the client should I experience any difficulties in terms of fulfilling my obligation, or I simply have a duty to deliver the actual goods and services. So that's why it's a contract liability. It was a nice interaction in the class when someone mentioned a payable instead of a contract liability. And that's nice, but remember a payable, you're only recognizing a payable if the only thing you're waiting on is time. I hope that makes sense. If the only thing you're waiting on is time and you've already delivered all the goods and services. So in this case, there are two things we haven't done: is delivering the goods and services and also time. So there are two conditions. But with trade payables, the only thing is just time. You're waiting to pay because you've already received the items in questions. So think of your trade payables, your suppliers. That's how you would record the trade payables. If only the only thing you're waiting on is just time to pay the money and you've received the goods. Now, in this case, we haven't yet delivered the goods and we're just waiting on time. So hence, it's a contract liability. And then now, on the week that it arrives, it's simple now in this case. You deliver the goods, meaning that step number 5 has been fulfilled. On that week, that's the only time you can recognize revenue. So what do? Simple, very nice and simple. You debit now contract liability. You remove the entire contract liability. Why? Because you no longer have any duty now to do anything because you just did the duty. So you remove the entire contract liability, debit it. Now what are we crediting? Finally, our sister revenue, because now we've fulfilled the performance obligation. Okay, and then that's step number 5. But then now, the theory one that I'm worried about that they may ask you is, perhaps they will give you a service to say, will this service be delivered at a point in time or over time? So you need to be able to define the 3 criterion there, whether it's at a point in time or whether it's at satisfied over time. So that 3 criterion, it helps you to ascertain whether the service will be at a point in time or satisfied over time. I know some of the items are going to be easy to identify. For instance, a car. If you're selling a car, you know that the actual car itself is going to be at a point in time because you are going to give it to the person immediately right now. It's not going to be something that you're going to give for over the years. You give them once, so it's at a point in time. And you'll be tempted to just say at a point in time, full stop. But you won't get any marks in there. You'll still need the 3 criterion to assess. And if you said no to any of those 3 criterion, therefore it's definitely at a point in time. But if you said yes to those, therefore it's satisfied over time. I hope that makes sense. So you can't escape that one. If they ask you at a point in time or satisfied over time, you need to list that criterion. I remember one of my undergrad questions, it was out of 10 marks. And on that part, I think I had 1 or 2 because I had answered literally that at a point in time and I forgot to actually include the 3 criterion. I regretted that time, but at least I did better in other sections. But my point is, don't make that mistake again. Well, don't make that mistake like me. Right. And then what else do I think would be asked in there? The input and the output method. Oh, that one is very simple. You should be able to define what is the difference between the input method and the output method and provide any examples of those. So please be careful on that one. Don't go to that exam without knowing the input and the output method on step number 5. Then speaking about contract costs. Now, contract costs, these are additional items. You need to know them. What is a contract cost? What else in terms of the contract costs? Also, your loyalty points, how to deal with them. It's very nice and simple again, that one, guys. Make sure you don't forget the loyalty points. They just create an extra performance obligation. So, and they are very easy to calculate as well. And then make sure you know how to allocate a transaction. Perfect. You're going to deal with that one in this example that we're going to do. Make sure you know how to deal with settlement discounts, significant. Okay, I've already mentioned this one. Okay, perfect. So I'm going to go to the screen to check and confirm if everybody's still breathing and alive. And if perhaps you have any questions on here. Okay, so say, will it always be applicable to use the 5-step approach when answering questions, although they do not specify to use this approach in the question? Because I noticed that questions do not explicitly state this in all cases. I like a question because number one, I don't think they will ask every problem for each step. Some of the steps are going to be easy. For instance, you will notice that you do have a contract, so there's no ambiguity about it. They will tell you, for instance, that customer and the entity entered into a contract. So that means step number 1 fulfilled. Don't answer. There's no reason for you to discuss that one in the exam because it's already been explicitly mentioned to you that A and B entered into a contract. And then they continue to say the contract price was 19.2 million. That's already step number 3. But obviously, you just need to make sure that you constrain it. That's your calculations. And then they say to deliver, to build, let's say, an apartment. That's step number 2 for you. That's a performance obligation. So, and then they would say that now calculate the amount of revenue to be recognized. So now what they're trying to do now is go back to step number 2 and constrain your amounts. So now your focal point now will be on step number 3 as opposed to step number 1, step number 2. It's rare for them to ask you to analyze the transaction in terms of all steps. I think they would be very, I would be very depressing actually if they would say that, like, analyze this transaction according to all steps. But then I think it would be easy, like it would not be a difficult transaction to analyze. So you would just have to say, if they ask specifically like that, you just have to focus on step number 1. Do we have a contract? Basically, do we have parties who agree on fulfilling their responsibilities and duties? If yes, then you can just move on to step number 2. Do we have a performance obligation? Yes, we are going to build an apartment. Do we have a transaction price? Yes, we're been given at 19.2. Allocated to a performance obligation. We can allocate it. Then step number 5, now perform this thingy and recognize the revenue when you've performed. Yes, we can do that, but it's rare for that question to appear. So I think they will only focus on step number 3, which is now determining the transaction price, or step number 5 in terms of theory-wise, where they ask you all those stuff. So I doubt, I wouldn't recommend you to expect a full-blown question on each step, but rather be able to answer each step in terms of if they were to ask you for each step. And then so say, is the bathroom a distinct good? So in this case, the example of a bathroom, what I was trying to emphasize on is that the goods and services that are in there are distinct individually on their own. However, now in the context of the contract, they are not distinct. The only thing that's distinct now is the bathroom itself, as opposed to those goods. Right. So the answers in the back of the textbook. Use the term deferred service revenue for the remaining services that we still need to provide it. Do we swap that term with contract liability? I'd prefer contract liability because that's what you're going to be dealing with, not only from here, but when you also further your own studies and postgraduate studies. I have never heard deferred services revenue. The book is a little bit, but yeah, but I would definitely just use contract liability. Which three criteria for step number 5 theory? Thank you. So page 36 of the textbook. Thank you so much. Hopefully you've got that one. Right, so we're going to go now to the last learning unit, which is IS 19, employee benefits. Also one of the most easiest learning units or standards in this case. IS 19 employee benefits, just simple stuff. So we have short-term benefits here. Your short-term benefits are your salaries, basically. I think the only new thing, well, not new, I don't want to make it new and make a spectacle out of it. It's not new at all. The only term that is basically new, it's when we debit employee benefit expense. In most cases, you don't need to write that down. Like, for instance, if you're paying a salary, you can just simply say debit salary expense, credit bank. But IS 19 obviously would say debit employee benefit expense and credit bank. That's one and the same thing, because it's simple. Employee benefit expense is just simple salary. It's salaries for employees. So I wouldn't penalize you at all. But if you're uncomfortable with that, you can always use employee benefit expense, like the jargon that they use in IS 19. But myself, I wouldn't be bothered at all. Short-term benefits. So payments such as salaries, very easy. We don't even have to touch that one. The only one that we need to, so the ones that we need to concern ourselves with is the leave payout. Okay, leave. Important. So you will need to know whether this leave is accumulating or non-accumulating. And after knowing those, you also need to know in terms of accumulating whether it's vesting or non-vesting. Okay, so accumulating means that you can take it over. If you haven't used your leave in the current year, you can take it over to next year of assessment. Perfect. Non-accumulating, if you didn't use your current leave this year, then you forfeit it. You will never have it again. Then let's go to vesting and non-vesting. If it's vesting, it means that it is capable of being converted into cash. What do we mean by that? It means that let's first say if it was accumulating and vesting. So accumulating and vesting, it means that if you didn't take it this year, you can carry it over next year and you can convert it into cash. Okay, perfect. So that means then we have a full-blown liability. Hope you can agree with me, because at any point in time, even if this person were to leave the entity, we would have to pay them for that leave they didn't take, because in any way it's going to be converted into cash, whether we like it or not, because it's the rule of accumulating and vesting. That means we'll definitely have a liability in there. And then let's speak about what if it's accumulating and non-vesting. Non-vesting means that you can't really convert it into cash. So it's very simple from there. They're going to tell you the entity's past practices. They're going to tell you the leave is accumulating and non-vesting. And there are 35 days of leave not taken. And in the past, employees will take, let's say, 20 days. So you will use the 20 days because you are projecting, you're basically providing an estimate. Non-vesting in the sense that it's not converted into cash. That means now you must constrain your amount by using that 20 days as opposed to 35 days that they actually have. That's if it's non-vesting. Then let's speak about non-accumulating but vesting. Non-accumulating but vesting, again, is a liability at your end. Even though you can't carry it over next year, but if it's converted to cash, then we know that a lot of people are going to convert it into cash. Or in fact, we know that it's going to be converted into cash and be given in the current year. So the current year's leave will be converted and then given into cash to those employees. So it's going to be full-blown liability. And then let's say non-accumulating and non-vesting. Now that's very simple. If you can't carry it over next year and it's also non-vesting as well, that means you can't even convert it into cash, then sometimes you don't have a liability in there. There's no liability at all because we don't owe anybody anything by the end of the year if somebody didn't take their leave, because it's non-accumulating, meaning that you can't carry it to next year, and it's non-vesting, meaning that you can't convert it into cash, even if you like. All right, so I've also included those examples in there. Again, the journal entries are always so simple. You simple debit employee benefit expense, aka salary. And then you credit leave pay accrual or leave pay payable, whichever word that you like, but basically it's a liability that we are going to pay or foresee to pay in the future. So that will be the general entry for that one. And then they also have profit sharing bonuses in there. You just need to read your scenario perfectly, because they like to use English that confuses, to say, employees who are going to receive the bonus for the year are those who have been with the entity since at the beginning. And then all of that stuff. I know it's confusing, but just make sure you don't overthink the English that's in there. So if they tell you that the bonus, you're only getting it if, let's say, your profits are exceeding a certain amount, therefore check if the actual current year profit did exceed, or in fact did exceed that amount. If they did, that means now those employees will be entitled to a profit. They will give you the percentage, maybe it's 10%. So you just take that current year's profits, multiply by 10%, and then that's your actual bonus payable. So you will debit employee benefit expense, and then what are you crediting? Bonus payable with that amount. And then if they ask how much for each employee, it's very simple. You take that bonus amount you just calculated, then divide by the employees who qualify to get that bonus. They will tell you the restrictions and all of that. So I don't want you to overthink it too much as well on that part. And that's also for profit sharing. Yeah, so that's bonus and profit sharing and all of that stuff. And then once you're done with short-term employee benefits, you move on. Sorry, you move on to post-employment benefits. Post-employment benefits are defined contribution plans and defined benefit plans. Yes, you need to know the definitions of these two items. They are very much important. You will need to know them. Also, please use your book for this one. I guarantee you all the questions that are going to be asked will resemble the book. Why am I saying so? It's because even on my undergrad and postgraduate years, I actually haven't learned myself about post-employment benefits. We're always told to ignore it and all of that stuff. Not because um what you call psyche in this case undermined our intelligence, but this post-employment benefits is one of the most intricate parts in terms of IS-19, because it involves a lot of estimations, and it involves your insurance companies, where they're actuarial people, where they take into account the risks within any investment or a plan or a defined plan as it is. It's almost what do you call this? It's almost like mathematics and calculus and accounting brought together. So the only thing that you need to know, guys, is the basics. Obviously, the 5-step approach that is given in the book, yes, you need to just know the basics and how to apply those. Normally, at a high level, that is the most intricate part of the IS-19, because it involves a lot of estimations, and also not a lot of companies do these things. They don't have defined contribution plans, defined benefit plans. It's only those big companies like your gold, sorry, your mineral companies, the one who works in gold and what do you call all these minerals, mining and also mining companies. They are the ones who have these big things that they need. And then the rest of the companies that you're also going to be exposed to, I hope you don't meet this these post-employment benefits, because they can be a lot of headache. But in any case, please make sure you understand, you can be able to define those, and then just work through the examples in the textbook, and then apply them to the questions. So that should be fine as well in terms of that. And then you go to your termination benefits now. Once we've discussed the post-employment benefits, the termination benefits are very nice and simple, in that you just need to receive an offer. What's this offer? The offer to terminate your services. So if you received an offer and then the employee accepted it, therefore it's a termination benefit. But if an employee just randomly decides to terminate their employment without any offers of termination, then it's not a termination benefit. Any amount that they receive will not be a termination benefit. Again, in this case, what do you do when you pay when you pay out a termination benefit? It depends on the length of time that you're going to pay this one. So if the termination benefit, you're going to pay it immediately, therefore just treat it as a short-term benefit. What do I mean? I simply mean just debit employee expense, then credit termination benefits payable or bank if it's paid immediately. And then if it's going to be paid in a period of 12 months, that means you will need to record a non-current liability. because now it would not be a current liability but a non-current liability. So it will be termination benefits payable but under non-current liabilities. Basically, as a long-term kind of thing. Right. And then let me just check there. Be able to define this. The disclosure is important. Overall. Okay, so I'm gonna. Okay, perfect. This is for you to study. That's not for me. Right. And then I'm gonna do an assignment question just now. That will, it's out of 100 to show all of these questions. I won't do them in detail, but I will explain the most important things you need to know in terms of answering that question. Then obviously I will give you the solution. Then you can check out everything. And then, yeah, then you can take it from there. So I'm going to go back to the screen just to check if there are any questions emanating from this one. Employee benefits. So could you touch on the input and the output methods? So the input and the output methods, I'm not sure what specifically do you need from there, whether you want, I'm not sure. I'm not sure. I'm not sure, but could you send me in detail what you meaning with the input and the output methods? Because they are just explicitly defined terms in terms of your textbook and also my slides, like, and also with the examples. So I'm just not sure if perhaps you had an example that confused you and all of that, then we can talk about that. Can we touch on dividends for I-7 on page 10? I found it. I think we did touch on dividends in the very first start on the thingy, like the dividends being declared in the current year or the dividends declared after year end. But I'll quickly just check for this example and see if it aligns with everything that we've mentioned in there. Page 10. Page 10. Page 10. Page 10. Page 10. The following information relates to the financial year end, 27 June, authorized for issue, approved on AGM, approved, authorized for issue, 31st approved, dividends 31st July, declared by directors no, 31st, that's also 30 June, approved in the AGM, yes, dividends will be upon funded. If financial statements recognized in submissions in equity 20.8, disclosed. Yeah, they are still talking about the same thing that we've already mentioned. So if a dividend has been have been declared during the current year of assessment, then it's gonna be disclosed in the current, like it's gonna be an adjusting event because the constructive obligating event happened in the current year. Then if it's issued between after year end and then in the period before the financial statements were issued to the public, then that means it's going to be only disclosed in those financial statements and it will be a non-adjusting based on the reasons I also provided on the thingy on the first session when we spoke about the what do you call this thing, when we spoke about IS10, the dividends. Just get the recording and then just after we're done obviously, and then just go back through that session, then yeah, hopefully it will provide something, some cover. So I'm just gonna give you guys a 10-minute break, and then we can, no, actually let me make it 5, yeah, a 5-minute break, and then we can be back. Just 5 minutes, just to grab some water or something. So we'll be back at 9. Should I just say 10 now? Welcome back, guys. I hope you had a nice short break. I've projected my screen for the assignment question that we are going to do just now. Yes, let's get to the fun part now, the assignment question. All right, so we have question number 1 here out of 35 marks. I've also highlighted here, let me just increase my thingy, perfect. I've also highlighted, I'm also going to share the highlighted version. Basically, when you are in an exam during the reading time, what is it that you are highlighting? What is it that you're looking for in the exam section before you start answering your questions? So here we have Anuko Pty Limited, who is an online clothing wholesaling company who is situated in South Africa. The financial reporting department is currently in the process of finalizing the financial statements for the year ended 30 June 2025. You highlight this. Why? It's your year end. And then also you can even anticipate what's the beginning. It's the 1st of July 2024. So you highlight that part and then just write year end. Then this says here, the following came to light between 1st of July 2025 and the 1st of August 2025. So that means 2 months down after the reporting period. The financial statements are expected to be authorized for issue by end of September 2025. So that means they're actually going to take 3 months' time. Okay. So this information came between the 2 months' time, 1st of July and the 1st of August. So before we even dive into any question, so if there's any information here that so if there's any information on this date, which is 1st of July 2025 and the 1st of August, that is providing more information that already existed as in 30 June, that means it will be an adjusting event. But if we have any information happening on 1st of July 2025 and the 1st of August, and it's just an independent event that is not providing any information as at year end, then it's a non-adjusting event. But be careful, such information may need to be disclosed. We just need to know what type of information is that one. All right. They say here, number 1A, we have Mansfield Limited. Who's this Mansfield Limited? Let's check it out. Mansfield Limited is a debtor owing Anuko. So basically, we are Anuko's this company. Mansfield is a debtor. So they owed us 150,000, right, as at 30 June 2025, which is before a year end. They had been experiencing financial difficulties, and as a result, us as the entity will process the journal entry on 28 June 2025. That means at some point we were aware that the client is experiencing financial difficulties, okay? And we were aware of this information before year end. Hence, we processed a journal entry, which is debit credit losses, then credit allowances for doubtful debts. Perfect. Then it says now in July, which is now after year end, Mansfield's Limited lawyer confirmed that it will probably not be able to pay 25% of its outstanding debt. So the confirmation now from a lawyer is being received after year end. Is it providing information on something that already exists at before year end, or is it something that's new? And it's so simple now in this case because we already even processed credit losses on 28 June. That means it's providing more information on something that we already know. What is that? It's an adjusting event. Okay. The fact that the lawyer confirmed on July has no bearing in terms of the conclusion that it is an adjusting event. So we'll need to adjust our financial statements. And luckily, they were so lucky to even provide us a journal entry. So you process the same journal entry, but before you do that, first let's calculate in terms of how much money we are not going to get. Basically, we're going to say 150,000. Then multiply by 25%. Obviously, that's going to be higher than 32,500. And then you just simply now take that money, which is 37,500, then minus 32,500, and then you process the same journal entry now, but with that difference. So that's the only thing you need to do in terms of this case. So you explain it's an adjusting event. You explain why, because it's the condition, which is the financial difficulty, had already been in existence before year end. So that's your reasoning. And now what's happening now in year end, which is the lawyer's confirmation, is just providing more details on an event that already was in existence in prior year. It doesn't change the conclusion that is an adjusting event. And then how do we adjust our financial statements? We process a journal entry. What is this journal entry? It's the same one. But then obviously we need to calculate first 150 multiplied by 25%, and then take that amount minus this that's already been processed, then voila, we have your transaction complete in terms of that 12 marks. You get your 12 marks. Perfect. Let's go to B. B says Elsfield Limited owed Anuko, which is us, an amount of 650 as at 30 June 2025. Earlsfield Limited lost a container of goods at sea in June 2025. Right. Now, our client lost a container of goods at sea in June 2025. Okay. And it has been confirmed that it would only be able to settle 75% of the balance owing. Okay. Now we ask ourselves, is this an adjusting or non-adjusting event? And it's so simple, an adjusting event. Why? Because Earlsfield, which is the customer, they had an event which led to them unable to settle their amount before year end, because this happened in June 2025. And we know our year end is June. So this happened before our reporting period. So in this case, we knew about this information. So what do we do then? We simply process the same journal entry we've processed above. Same journal entry, let's go back, meaning we debit credit losses and credit allowances for doubtful debts. But now, what amount are we going to use? They say they will only be paying 75%. That means then 25% is the amount we need to calculate. So 650 multiplied by 25%, and then that's your value of your adjustment. So you explain it's an adjusting. Why is it an adjusting? We're looking for the event that must have happened before year end. What is this event? It's the loss of a container at sea, which led them to being in financial distress. All right. Then you process that one, happiness, and then let's go to C. C, very nice and simple. A dividend of 430 on 20 May 2025. Very, very simple, guys. It's like eating a cake again. Like a dividend, we're looking for two types of dividends. The first one must have been issued in the current year, and there is our brother there, 20 May 2025. So what do we say? An adjusting event. What's the reasoning? Because there is a constructive obligating event. Why? Because of the word declared. What does it suggest? It suggests a present obligation. But wait, what is the past event? Past event is the 20 May 2025. Are we expecting the outflow of economic benefits? Yes. What does that mean? It means a liability definition has been met. Therefore, a liability must be included in the records of Anuko Limited as at 30 June 2025. So nice and simple. What's going to be the journal entry? Simple. You debit dividends paid, you credit dividends payable or bank. It's like drinking water. And then let's go to number B. A dividend of 390, but now when? On the 1st of August 2025. When is this? It's after 30 June. Careful now. So you mentioned non-adjusting event. Why? Because the declaration only happened on 31st August 2025. That means as at 30 June 2025, there is no present obligation as a result of a constructive obligating event, meaning that we will never recognize a liability. But what do? We disclose. So we will disclose this dividend. So we will mention that a dividend of 390 was issued on the 1st of August 2025. Simple. So, but on which financial statements? Again, let's go absolutely don't forget. On these ones, the ones that end on 30 June 2025, even though it was issued on the 1st of August 2025, because we are ruled out by this timeline here. Hence, you needed to highlight that part. Perfect, perfect. Just check if we've answered all the questions. In each instance, discuss whether the event is an adjusting event or non-adjusting event. We just did that part. Whether the event is adjusting, provide the appropriate journals. We just did that as well. Whether the event is non-adjusting, discuss whether the disclosure needs to be made. Yes, we did that on the last part where we said non-adjusting, and we did say that disclosure should be made. All right. And then it says, provide a reason to support a decision, and we've been providing the reasons as well. Okay, perfect. I'm going to go to question number 2, but before I do, I'm going to go back to the chat to see if everybody is breathing in, no questions or anything like that. The slides I was referring to also was from your side, your lecture slides from your lecturer, hoping that they have included this information. But if they haven't, then I can share with you. Just send me an email. I can share them with you. But the rest of the other items that I used here are gonna be shared, like the tips and the solution of the assignment and the question. Right, let's go to question number 2 without wasting any time. That was question number question number 1, which is IS10, events after reporting. Perfect. So it says here, New Apartments is a company specializing in the construction of low-cost housing throughout South Africa. they were awarded a tender contract by South African Properties to construct a 3-story building with 30 residential apartments in Braamfontein. Do you see how everything has already been detailed to us? They say New Apartments is a company specializing. They were awarded a tender by SA Properties. That means there is a contract. Step number 1 has been fulfilled. That means we have identified a contract. What are we going to do? To construct a 3-story. That is step number 2, which is a performance obligation. Okay, and then it says your contract price of 19.2 was agreed upon. Perfect. That is now basically determining the transaction price. We're given as well. Obviously, that means we'll focus on step number 2, which is now because it's going to be satisfied over time. I can already tell it's not going to be at a point in time. So we'll need to understand how do we measure revenue basically. So that's going to be our problem of the question. How do we measure revenue? So it's not step number 1 because we've met the contract. We've already been told they were awarded a tender contract. That means there is a contract. Number 2, performance obligation. Do we have one? Yes, it's only one, which is the creation of a 3-story building with 30 residential apartments. Okay, for those ones who are asking me, also maybe I could talk about the input and the output method in this case here, but not too much. But if you notice here, they say here, let's talk about output first, which is the result. If we were to measure revenue, we can use the output method, which is now the 3-story, which is the 3-story building, or the 30 residential apartments. We can use that. So we can measure revenue using a 3-story, meaning that once we've finished 1 story, we can measure revenue. The 2nd story, measure revenue. 3rd story, measure revenue. Or we can use 30 residential apartments, which is after we've completed one residential apartment, we can use this as well, like to measure for that for that revenue up until we finish all of this. So with your input, it will be the things that you use to create this. For instance, your costs. Now, because you will be using your cost, like buying materials to actually produce this item. So it would stand to reason that if, let's say, you've incurred 2 rands of your costs, then you ought to recognize revenue that is equivalent to 2 rands, depending on the total value of your costs. So that's one of the input and the output and all of that stuff. Then a contract price of 19.2 was agreed upon on 1st of April 2024. Underline this part, 1st of April 2024. That is the start of the contract. It's going to be very much important because we can also use time. Time will be an output in this case, which is we can use time to measure what you call revenue. For instance, now, since it's 19.2 and say 19.2 divided by 3 years, and then obviously in each year we recognize that revenue, following year we recognize that revenue, 3rd year we recognize that revenue. Obviously now this date is going to be important in that case. Then it says here, it was expected that the building would be completed in 3 years' time, that the total costs to complete would be 15,840. Okay, 15,840. On the 1st December year end, the actual costs were 5544, and then the new apartments had buildings to date of 6,600,000. The performance obligation will be satisfied over time, and as such, new apartments recognizing revenue uses the percentages of completion method. Good for them. Now let's see what can we help them with here. They say calculate the gross profit and contract asset or liability at year end using the information for the first one, completion method based on time lapsed. The number B, completion method based on costs incurred. Okay, let's not waste time. Let's do that. Time elapsed and costs incurred. Time elapsed and costs incurred. Perfect. Let's do this. So the first thing you want to do in an exam, you want to collect all your data down. So we'll have a contract price. We're given, it was 19,200, 123. Perfect. Sorry. And then, what else were we given there? We were given the costs, estimated costs. I think it was 15,840, 123. Let's go and confirm just to see that we are all this together. Yes, I think so. I saw, yeah, 15,840. Okay, perfect. And then we have now the number of months during the current year, during the year. Remember, it said we started around the work commenced on the 1st of April. So 1st of April to 31st of December, that's 9 months. So 9 months. And then number of months in total now, in terms of the contract, they said it's 3 years. right? 3 years. That means now it's going to be 36 months. Okay, 36 months. Okay, perfect. And then this is a what you call percentage. Percentage in the form of months or time in this case. So we're going to say, because we want to know for the current year, so you're going to say 9 out of 36 and then times 100. Sorry, then times 100. That's going to be 35% equals to 9 out of 36 or 25. Okay, 25%. Perfect. Right. And then let's talk about the costs, okay, the actual costs incurred. Actual costs incurred. Let's check that one out. The costs incurred were actual costs is 5,544. 5,544. Okay, perfect. 5,544. 5,544. 1, 2, 3. Perfect. Okay. Okay. And then now this percentage in the form of costs. That means we are going to say 5,544, 1, 2, 3 divided by 15, 840, 1, 2, 3. Okay. I wonder how much is this? It's 35. Let's check. That divided by that. Yes, perfect. It's 35%. 35%. Perfect. Right, now let's get to the fun part. So let's say it's based on time. They said recognize the revenue. If it's based on time, let's go and check. Yes, so compilation method based on time. Perfect. It's easy stuff. So, okay, sure. Now we're looking for our brother revenue. There you are. And then now we were told the contract price is 19,200,000. Perfect. And then what do we do with it? So based on time, we have a percentage here. There is time, 25%. So multiply by 9 over 36 or 25%, whichever you like. And then now let's do this one, then times by that one. That's 4.8. Okay, perfect. 1, 2, 3. Sorry. 2, 1, 2, 3. Perfect. And then now we're going to talk about cost of sales. So we're going to follow suit. They're going to follow suit. So the cost of 15, 840, 1, 2, 3. Therefore times 9 over 36 or 25%. Perfect. And then that's going to be you over there multiply by, where is that thing now? Oh, calculation almost didn't see. Multiply by 25%. Is it? Yes, 25%. That's 3,960. Okay, perfect. That's 3,960. 1, 2, 3. Perfect. Lovely. Then we have our nephew gross profits. Okay, equals to that guy over there minus this guy over here. Perfect. That's 840. Okay. Right. And then now our billings to date. Billings to date. What do you call billings to date? Actual costs incurred. It's 544, 1, 2, 3. Okay, perfect. Billings to date. We were given this amount as well. Let's go and check it out. Show yourself billings. Show yourself. There it is. 6.6. Perfect. Let's go and put that down. 6, 1, 2, 3, 1, 2, 3. Perfect. Right. Billings to date. And then we have gross profits. Okay. Profits. Let's check this one out. That plus minus that one. Perfect. Okay, sure. Now let's compare. We're comparing two gross profits, these two guys. The other one has 1056, the other one has 840. Okay, sure. So now we want to know whether we have a contract asset or slash liability. Okay, perfect. And then we do this simple. We take this guy over here minus that guy over there. Then we have 216. Right. So in this case, let's just put it, I want to do this. And I want to do that. And I want to do, and I want to do this. I want to do this. Perfect. And I want to do this. And I want to do this as well. Perfect. Then let's go. Let's go. Let's go. Let's go. Completion based on cost. Oh, lovely. Lovely. Let's go do the cost one. Now, based on costs. Based on cost, we grab this guy over here and then just put it next here. Perfect. Right. Now it's based on costs. Okay. Based on cost. So it's gonna be now, let's check our details on cost. Look at our costs. Smiling there at 35%. Perfect. So we do that. So we say 35% in this case, 35, or, so remember, it's not going to be none over 36 now, it's going to be the cost method, which is at 5 million there, that 5M, I'm not going to write the full amount, you know exactly what I mean now, divided by that 15M, perfect, 35%, see above, obviously, and then we do the same thing here to this guy over here. We say 5M over 15M, lovely. And then we say 35% because it's based on cost now, which is the input method. The other one was, say here, based on cost. Perfect. And now we're in a position to calculate these guys over here. So it's going to be that 19,200, 123, multiply by 0.35. 6720. I hope it's right. Please confirm with me, guys, as we're doing these calculations, so that we're all in this together. Then we also have minus 15,840, 123, therefore multiply by 0.35. Perfect. Right. Okay. We're winning. We are winning. My goodness, this is so nice. Right. Then we take the same information as it is, and then just put it here. Put it here, put it here. Perfect. That means now we have finally fulfilled all our answers. Perfect. And this one. They didn't ask for journal entries in here, but on the solution that I'm going to share with you, I did provide the what do you call, the solution together with the journal entries after this question so that you are comfortable. Right. Let me check if there are any questions regarding this. Thank you. Thank you. About the time lapse method, I've seen a past paper saying the work commenced on the 2nd of the month instead of the 1st. Would the time lapse still be months even the work? Oh, I see. That's actually a technical question because truly you would want to know if you want to use days for more accuracy. But I think if it's just the 1 or the 2nd, then just use 9 months. It's not material that much, like the days. I think what would I consider material? Maybe if we started on the 15th, oh goodness, but I don't want to go there and I hope they don't go there. But then I would use months. Yes, I would use months. Well, I share the solution all the time. I always do. I always do. Yeah, so just to rely on the months, like the 9 months. Don't worry about whether it's on the 1st or 2nd. Like it seems a little bit immaterial, the days themselves. But I do get your point, very much valid, because you want like the accuracy of it. All right, all right. Thank you, guys. Then let's go to question number 3. Question number 3. Okay, this is a nice one as well. It looks lovely. Looks lovely. Lovely. Right, it says you are the newly appointed financial manager of EVAC Limited, a dealer in motor vehicles. EVAC Limited sold a motor vehicle with a 5-year maintenance plan for an amount of 243,750, excluding VAT, on the 1st of January 2025. Perfect. So I hope you can understand with me. We have 2 performance obligations here. Okay. This is the first one. I will write it down. Our first performance obligation. Why? It's because it's delivered at a point in time. The motor vehicle, we will give it to the customer like on that date, 1st of January. But then we have a second one, second performance obligation. Let's write it down. This is the second PO. Why? Because now this is given over a period of 5 years. Okay, perfect. It's given over a period of 5 years. So in this case, what will we need to do here? We need to, let's check how much is it for an amount of 243. Okay, perfect. Now, the same motor vehicle can be sold without a maintenance will be 200K. Okay, this is nice. That means now the rest of the 43,000 is for the, what do you call, is for the maintenance, because the standalone cost for the motor vehicle is 200K. Then the rest now would be the, what do you call, for the maintenance. Then they say there, from your required, calculate, what do you call this? Calculate the amount that will be recognized as revenue in the statement of profit and loss. State the conditions that will be satisfied. Okay, this one is theory. We've already covered it in terms of our revision just now. Basically, it's going to be reflecting on the 5-step approach. Yeah, just one step mentioning the condition that must be satisfied in order for revenue to be recognized from the sale of the motor vehicle to be recognized. Obviously, the car must be delivered. Remember our step, the 5-step approach, meaning that the ownership must change from us to the client. And then obviously there should be prices and should be relevance and faithful representation, all those kind of stuff. But you will see on the solution, it's not horrible in English. Basically, it's stuff that you can understand. So I won't dwell on much on this one. But what I wanted to do was the calculation, because I don't want you guys to be struggling with calculations. You already struggle enough in terms of other things. So calculate the amount that will be recognized as revenue in the statement of profit and loss for the year 31st December 2025. Okay, that's very nice and simple. We bought this on 1st of January 2025. Let me just put this in an Excel so you can see my vision here. Okay, all right. So we have 2 performance obligations. The first one is a car. Second one is a maintenance plan. It's a maintenance plan. Perfect. Maintenance plan. Okay, the car is costing 200K. That's a standalone price. That's a standalone price. Perfect. And then the maintenance plan is costing 43. Is it 750? I'll just confirm just now. 43, 750, 43. Yes, perfect. Okay, perfect. Right. And then we get the sum of these 2 guys over here. I didn't do that first thing. Yes. In any case, fine. Okay. And now one thing that's interesting that I noted about this question is that let's check at this table here, the estimated maintenance cost over the next 5 years. These are the estimated costs over the 5 years. Okay, so we have 5K plus 6K plus 7K plus 8K plus 9K. All of these leading up to 35,000. That means we're estimating the cost of 35,000. Okay, so that means in 2025, we're going to have to recognize the revenue in relation to this cost. Okay, this is the cost. Remember, we're looking for revenue now. Revenue obviously is going to be taken from the value of that 43,750. What do I mean by this? Let me go back to my Excel sheet so you can see this. This means this amount here will be revenue, the 200K. This will be revenue in 2025. Do you agree with me? Because if we have sold this car at a point in time in January, that means we have delivered the service. So it's delivered. What does it mean in terms of revenue model? Step number 5 has been fulfilled. That means now we're in a position to recognize the revenue. But with the other one, maintenance, we can't recognize this amount because it's over a period of 5 years. That means we only need to recognize the one that's only attributable to the current year, only the 2025 one. So how do we do this lovely business? Okay, we do this by saying 5K, okay, 5,000. Okay, let me just put it like 5,000, which is the estimated cost in the current year, divided by 35,000. 35,000 being the total costs of all of these things. Like if you add the, let's go back. If you add the 5K, the 6K, the 7K, the 8K, and the 9K, you should get 35,000, which is the cost. Okay, perfect, perfect, perfect. Then what do you do with this? It's very simple now. We just simply multiply by 43,750. 43,750. And then it should give us something like 6,000-ish, 6,000-ish. Let me just calculate it now. 5,000 divided by 35,000, then times 43,750. Yes, perfect. 6,250. Perfect. So that means now the only revenue to be recognized for the current year of assessment would be that 200K plus the 6,250. So revenue to be recognized at 31st of December 2025 is then 200 210.06. Is it 250? Yes, perfect. Perfect. That's going to be the amount to recognize of revenue in the financial statements. All right. I'm going to go to the screen just to check if anyone has any question with regards to this lovely question. It was a breath of fresh air. Like, look, nothing difficult at all. Like, you can even do it with your eyes closed for this one. Let me go and check on the questions if we have any. Okay, I think you are all still breathing. Okay, perfect. This is lovely. Let's go and check then the next question, which is now question number 4. Question number 4, what do you want from us? Okay, so they say on 1st of October 2024, France Limited sold a photocopier to a customer at a price of 22K. Included was also a free toner for 3 months, and then what do you call the others for free toner for 3 months and 6 months of free servicing. Oh, sorry. The other 6 months for servicing. Okay. So we have 3 performance obligations here. The first one is the photocopier, the hard copy basically. Then we have a toner, but it's supplied in 3 months time. That means we only recognize revenue for this one over time because we can't do it at a point in time, unlike photocopier. We will send the photocopier immediately to France, and then they will have ownership of the copier immediately. That means we would have fulfilled a performance obligation. Right, that means we are entitled to recognize that revenue of that one. Right, let's put this in an Excel sheet so that we don't get to be stressed. Perfect, let's do this, Okay, we're looking for our mother standalone prices. Okay, now let's look for our performance obligation. The first one is the photocopier. The photocopier. Okay. What is your standalone price photocopier? Let's go and check. They should have given us. The standalone selling prices of each contract components are as follows. Copier 16K. Oh, lovely, lovely, lovely. Let's do this. 16K. 1, 2, 3. Perfect. And then toner. Okay. Our brother Toner, what do you want from us? Let's check. Our brother Toner says that they for 1 month is 500 and we know it's for 3 months. Okay, let's do our multiplication business. So 500 multiplied by 3 months. That's going to be 1.5. Lovely, lovely, lovely. Okay, and then let's go to the, where is this now? 1 month servicing. Oh, servicing fees. Okay. Our uncle servicing fees. What do they have? I forgot now. I think it's 800. Oh, it's 1,000. Okay, perfect. 1,000 multiplied by 6. 1,000 multiplied by 6. Because it's going to be supplied for over a period of 6 months. Okay, perfect. And then how much is that? I think it's 6K. That's 6K. Then let's find the sum of all of these guys over here to see what's the business all about. 23,500. Nice. Okay, let's check how much were they going to pay us to begin with. Ooh, would you look at that? They were going to pay us 22K. All right. So that means we gave them a discount of some sort because they are going to pay us 22,000, which is the final amount. The final TP we were going to receive was the actual 22,000. So let's see how much discount did they give us. Oh, did we give them? Because remember, we are the entity. Sorry for that. We are the entity. Right, so it's simple, the calculation. It's very nice and simple. You can even do it with your eyes closed, guys. Look at this one. Look at that. It's going to be 16,000, which is the value of the the standalone price of the photocopier, divided by 23,500, which is the total cost of all the standalone prices, then multiply by the amount we expect to be entitled to, which is the 22,000. Then voila, you have 14,978 as opposed to 16,000. I just don't like this. What do you call this thing? Why you? Perfect. Perfect. 14,979. Now let's find how much discount did we make out of this minus that guy over there. See, we made a lovely discount of 1,000. They made a lovely discount of 1,021. Okay. Now we apply the same concept. So 1.5, then divided by 23,500, then multiply by 22,123. Voila. Oh, nice. It's like eating a Woolworths cake, guys. Ooh, ooh, ooh. Okay, perfect. So how do we calculate now? The difference is going to be that minus that. Okay, perfect. Then we do the same thing now. It's going to be 6K 123 divided by 23,500, then multiply by 22,123. Perfect. Okay, so, perfect. Let me just do that. Oh, come on. Okay, perfect. Now let's do the same thing here. That minus U. I hope this is right. Doesn't look right, but I hope this is right. Yes, perfect. Right, now let's check when did we give the service so that we can see if we are going to record all of that revenue in the current year or not. So this was on 1st of August, okay? So on 1st of August, do you agree with me that we are, okay, let me come back here, 1st of August. Okay, 1st of August. So we sold this on 1st of August. So you agree with me that we are going to recognize the revenue in February, because it was at a point in time we delivered the services, okay, revenue in February. And then this one is in 3 months' time. Now let's calculate if the 3 months falls within the year. So August, September, October, definitely revenue, all of it. Okay, let's check this one, 6 months. August, September, October, November, December, January. Oh, perfect, lovely. 6 months as well. So that means it's a revenue. That means the full amount is going to be revenue in the current year of assessment. Because all these months happen to be within the current year. That means we've delivered everything in the current year. Hence, we rightfully deserve the 22,000 in the current year of assessment. So nice, guys. Goodness, I just have goosebumps just now. Okay, let's check. Let me go and check if you guys have any questions in here regarding this. Questions. Okay, you're still fine. Then let's go to the last question. Out of 30, you have been presented with the following information of Star Limited for the year ended 30 September 2025. Again, we highlight our year end because we like our queens and kings who are concerned with their timelines. You want to make sure that your timeline is proper. It's not just you're not rushing. Basically, you know exactly which amounts falls in which year of assessment, right? And then let's go to A. A says Star Limited contributed 7.5% of all employees' gross salaries to the company's defined contribution plan. Perfect. That means now you're going to say 1.2 million multiplied by 7.5%. Okay, therefore that's going to be one of the amounts you're going to use in order when you're crediting this defined contribution plan payable. So with this sentence here, there's an obvious journal entry, which is credit defined contribution plan payable. Okay, it's going to be made by 7.5% of this 1.2 million. This is because it's Star Limited, the employer who's contributing. So the reason why I'm saying we may need more is because sometimes it's both of them, which is the employer and the employee, they contribute both. So in this case, this is the employer's contribution, 7.5. Then the employee also contributes 6%. That means now 1.2 multiplied by 6%. And then now you will credit defined plans, which is now with 7.5%. So you will add the amount you've calculated here together with this one, and then credit defined contribution plan. And then let's check the gross salaries of the employee are 1.2. Again, remember salaries. What did I say about salaries? Just simple debit salary expense and move on with your life. That's exactly what you're going to do here. You're going to debit employee benefit expense, aka salary expense, 1.2 million. All right, so now we have two items. We have this debit, then we have this credit here we're speaking about. Let's find other items. Pay deductions ended where 200K. Lovely, lovely. That means now we have another credit, two credits and one debit. I'll repeat, two credits and one debit. So that means now we're gonna credit pay payable by 200K. Right. And then obviously your debit side now will be bigger than your credit. And then that means the balancing is just salary payable or employee benefit payable because it's a liability. It's just a balancing amount. Nice. Then you move on from that one, from A. Then you go to B. B, employees are entitled to be paid for up to 7 days of their accumulated annual leave that is not taken. That's good for them. So up to 7 days. At 30 September 2025, there were 12 employees who together had a total of 25 unpaid leave. Okay, so they have unpaid of 25 days, right? That they didn't. Hey, wait, they didn't take. There were 12 who together had a total. Oh, okay, so they didn't mention. Okay, sure. An average wage of employee is 353 per day. All right. Yes, okay. Then payment for the untaken leave was made in November 2025. Okay, that means after year end. So that means on September it's a payable. So we're going to be crediting leave payable. Okay, credit leave payable, and then we're going to debit employee benefit expense. How do we do this? 353. 353 multiplied by the number of leave that has not been taken. Make sure you limit it to 7 days because they say employees are entitled to be paid out for up to 7 days of their accumulated annual leave. Then that's it. That's your leave accrual payment, basically. That one you're going to calculate in there. And then for the last one now, C, it says employees of Stars Limited have historically been paid a bonus comprising of 2.2% of EBIT. What is EBIT? It's earnings before interest and taxation, but only if that EBIT exceeds 10,850,000. Okay. That's nice stuff for us. Good news. And then it says EBIT for the year, it's 11,990. Music to our ears because we were expecting to be higher in any case. So 11,990 multiplied by the 2.2% will be now your actual, what do you call, bonus payable. So we're going to debit employee benefit expense. Work with me there. Then we're going to credit bonus payable. What is the value? It's 11,990 multiplied by 2.2%. Lovely and simple, just like that. Then they say required. In each required, prepare the journal entry to record the information on 31st December. We did that one from A to C. Narrations are not required. Answers must comply. Okay, perfect. Then it says using the information in C and assuming all eligible employees receive the same amount of bonus, calculate the amount of bonus payment which employee will receive. But that's very easy. It doesn't scare us at all. Let's go and check here. It says here the bonus is paid to all employees who were in the employ of Star Limited throughout the year and were still there at year end. Let's read the second line here. Employees at the end of the year, also employed throughout the year, were 15. That means that's the answer we're looking for. Ignore the rest. If I had a pen in an exam, I would scratch everything here because it's none of my business. So I'm going to take the amount, that 2.2%, simple divide by 15. Then I have now a bonus for each employee. So nice and simple. It's like really eating that Woolworths cake. Let me just come to the section, guys, and check if you are still breathing because that's the end of our paper, assignment paper. Do you have any questions for me? Any questions for me? Oh, thank you for that. Okay, I think, guys, you should be fine for your test tomorrow. Yes, yes, Shani, you can come through. Is it likely that the contract can be onerous? Or does the hand suggest that you're fine? You can come through though if you have a question. Is it likely that a contract can be onerous? Only in the realms of IS 37. Otherwise, for what you call for your IS for IFRS 15 and your IS-19 and your the very first one, IS-10, it can't be. It can't be onerous. Can I please have your email address? It has been provided on the chat. Just scroll up a little bit, you'll find it there. No problem. Otherwise, guys, if you don't have any questions, good luck for your exam. I wish you all the best. I am rooting for you so much. I am rooting for you. I hope you make it. And I'm hoping that it's not as bad as our first test from first semester. I think everyone had trauma with that one. So I'm hoping it's as good. It's good comparing to test two, Yeah. All right. Now, thank you guys. Thank you so much. Have a lovely day, so forth. Bye.